Joining me now is Craig Fuller. He's founder and CEO of FreightWaves, which compiles high-frequency data on the freight market for customers trying to navigate it. I think I got to start right there. What in the world are you talking about that it's compared to the great financial crisis? Maybe that worries me more than AI.
Well, we should be worried. The goods economy, certain portions of the goods economy are collapsing right now. So year over year, trucking volumes, this is really the predominance of freight that moves across the United States, is down 17%. It's important to unpack exactly what we're talking about is the retail freight, freight tied to the trucking market, which is really local distribution, is actually flat. So it's not seeing deterioration. It's probably why the Federal Reserve isn't overly concerned, because the consumer is staying pretty persistent. You see it in a lot of the retail earnings. But when you look at the industrial sectors, the folks are the freight that moves over the long haul. This is energy, automotive, housing, and manufacturing. We're down 30% year over year, which is very great financial crisis levels of concern.
So why are those sectors? I'm still not totally understanding as I'm reading. I mean, obviously heavy exposed to manufacturing. You think just because those areas of those businesses are slowing down because of the macroeconomic pressure?
Yeah, it's macroeconomic pressure. It's high interest rates. It's companies afraid to make long-term investments. It's really, if you think about where we've seen inflation related to tariffs, a lot of the tariff cost has been in wholesale prices and wholesale goods. And so it's not showing up necessarily in consumer prices, but it is showing up in those wholesale prices. And so those imports that companies are getting in raw materials is really taking a pretty big hit to those big manufacturers. And of course, housing, the story's been talked a lot on CNBC. Auto has its own issues with credit quality. Energy is an oversupplied market, but a lot of it comes back to the fact that manufacturing is the portion of the economy that's impacted most. And I think it's really interesting because Trump's tariffs were really supposed to drive manufacturing, and economists thought we would see the concern related to retail goods and higher prices for consumers. That's not showing up, but where it is showing up is the fact that a lot of demand in the manufacturing economy has basically gone south. And so that's the stuff that we're concerned about, because it means that underlying base of employment, there are 35 million people who work in jobs tied to the long haul goods segments. This is, again, energy, auto, housing, and manufacturing, and transportation is part of that, versus 2 million jobs in the hyperscalers.
Very interesting. I would love to get your take on the elimination, if we can, of the de minimis. I was doing some reporting about there's an awful lot of focus, of course, on the Temus and the Sheins of the world that had used that previous loophole, if you want to call it, but just that standard where you didn't have to pay certain tariffs and duties if you used the de minimis threshold. But other American brands were using it as well by potentially having a distribution center, say, in Mexico or in Canada, and then trucking things over. I mean, since that has gone away, have you seen any change in the movement of freight?
Well, it certainly has had an impact, and you see it in the parcel companies. This is why one of the reasons UPS's volumes are down is de minimis would show up in parcel. It wouldn't necessarily show up in truckload. Okay. And so what we're seeing in the trucking volume is a very different story. And what we're seeing in parcel is where you would see the de minimis exemption going away. And that's one of the reasons that FedEx and UPS have reported a much less bullish outlook over the last year. But a lot of this is the fundamentals of the U.S. consumer and the industrial sides of the economy is that effectively is a K-shaped economy. Consumers that are affluent are doing exceptionally well. And consumers in the industrial segment are actually doing quite poorly. So de minimis is a factor, but it's only one of many factors that's driving a slowdown in freight demand.
Okay, well, if I can try, I'm going to try to leave this on a positive note. What should we be watching for to see things change around, to see the trend going the other way?
Yeah, look, I think housing has got to come back. We've got to see the Federal Reserve ease rates. I think that's the most important thing for the freight market. As much as 20% of the trucking market is related and indirectly related to housing. So when people buy a home, whether they're buying a new home that's built or even an existing home, they're doing things like putting in new cabinets, putting in new appliances, furniture, changing out the carpets and the floor coverings. All of that drives a substantial amount of freight, as much as 20%. So without the housing market come back, it's hard to believe that the trucking market would follow. And so we want to see housing come back. And if housing comes back, then I think we can start to see a real recovery in the trucking markets.